Good afternoon, everyone. Thank you for joining us today. We hope you are doing well and staying safe. My name is Maria Asher, and I'm part of the investments team that manages the Westwood Select strategy. Today, we wanted to discuss our credit markets outlook. For that, we have Leah Bennett and David Plott joining us on the call as well. Leah is the president of Westwood Wealth Management Houston and is the lead PM on Westwood Select strategy. David is a senior vice president on our multi asset team with portfolio manager responsibilities across different products, including income opportunity, total return, and alternative income strategies. So, we have actually been getting a lot of questions on credit markets from our clients. So, we thought it would be best if we jump right into them. So, my first question is for David. Hi, David. How are you?
I'm great, Maria. Thank you for asking. How are you?
I, I'm doing well, thank you. So, we just wanted to get your opinion on the current state of the credit markets, and especially with the recent fiscal and monetary actions. What do you think their near term and long term implications would be?
Sure. Yes, thank you. It's a pleasure to be with you all today, and I'm happy to talk to you about where we are, where we might be headed in the credit markets. What we've witnessed over the past several weeks now is a clear bifurcation in credit, with high grade and crossover credit seeing a strong underlying bid, well supported by the Fed bond purchase program. And then those credits of lower quality really languishing at or near their widest spread levels or lowest price levels of the year. So, that's clearly an indication to us that the market isn't fully healthy yet. It's important to recognize most of the actions taken by the Fed have been really beyond anything else to provide liquidity to the market. This backstop has prevented markets from really seizing up, and they've certainly regained their footing and are functioning at a pretty good rate at this point. And as evidence to that, what we've seen is the primary market open up, especially for investment grade bonds that have seen record issuance in April. We expect more support from the Fed moving forward. Clearly, they can do some amount of yield curve control, and that's likely. They'll remain max accommodative for years to come, which really should result in a fairly flat but positive yield curve. And this will keep a lid on volatility and keep the markets acting in a more, I think, a regimented fashion. But with that being said, really how deep and long the downturn will be is really uncertain, and still we'll see an increase in defaults and higher spreads could very well be part of the next several months, if not quarters. And finally, I would say the implications of the massive fiscal stimulus and resulting ballooning federal deficit on top of this unprecedented monetary stimulus really could be sowing the seeds for an eventual bond bear market. I don't think this is likely in the short or intermediate term, but where we are today with all these inputs on the fiscal and monetary side is unprecedented. And I think it still remains to be seen how that will unwind over the coming years. But in the intermediate and shorter term, I think the support's there, and we should see a more normal type of market environment, especially in the higher grade corporate part of the market, given the Fed support and the Fed bond buying program.
Thank you so much, David. That's very helpful. My next question is for Leah. Hi, Leah. How are you?
Fine. How are you doing, Maria?
We are well. Thank you so much. So, Leah, just building on David's comments about the high likelihood of defaults, how concerned are you about our muni bond holdings, especially, with the downturn in the energy sector and the state budgets being significantly under pressure?
Yeah, that's a great question, and one that is also coming up quite a bit with clients. Dave's comments underscore how important credit quality is right now, and in addition to the pressure from energy prices, obviously the shut-in has had a big impact on different municipalities. You have less people going to hotels, sporting events, renting cars. Most cities receive a portion of those revenues, so there's quite a bit of pressures on different areas. I think that question is kind of a good chance to talk about our due diligence process when we're looking at purchasing munis. And different criteria that we use is we look for municipalities that have consistent operating surpluses, diversification of tax revenues, they have manageable pension obligations, positive demographic trends, and healthy liquidity reserves. And if you think about municipals versus corporates, for the most part, there's certainly some areas, some states that do have problematic finances, but overall, municipals have been a bit more fiscally responsible than corporate America, in the sense that there's only two AAA rated corporate bonds in existence now, and there's quite a few AAA rated munis. So we've stayed very high quality, buying AAA and AA rated bonds primarily. And then we also look for munis where there might be some sort of secondary bond insurance as well.
Thank you so much, Leah. That's very interesting. David, my next question is for you. So in Q1, we saw the credit spreads widening significantly. How concerned are you that it will happen again in 2020? And then again, under what circumstances could you see credit seizing up?
Hmm. Yeah, I mean, I think what we're seeing currently with a wide divergence between the haves and have-nots is going to continue. I mean, really, the lower quality segments of the bond market, they're going to struggle. We're going to see a surge in bankruptcies. I mean, we've been talking a little bit about energy, and let's just consider that. I mean, the well-capitalized companies like the major oil companies, they have and will continue to have access to capital. But when you look at some of the smaller E&Ps, they've spent above and beyond their cash flows. They're highly indebted. They have very little financial flexibility. This segment of the market's going to suffer, and you're going to see a surge in reorganizations, very low recoveries for bond investors there. So, I mean, what that means is speculative high yield will really be a stock picker's market where, basically good old-fashioned fundamental analysis will be able to provide some excellent returns, but really it's buyer beware, as there's going to be minefields everywhere. I mean, personally, I'd be watching CCC spreads. When they begin to outperform for a couple months, that might be an indication to wade back into the water, as they'll be really telling you the risks are diminishing. That's not the case today. CCC spreads are, just bouncing along the wides. So, I mean, I think we have a little way to go. And really for credit market seizing up again, I think that's unlikely. To get back to that situation we were back in March, but it's not impossible. Clearly, credit conditions for much of the economy continue to worsen. I mean, if you look at the credit managers index, it continues to fall. It likely is going to continue or fall further. Globally, the credit situation's bad as well. So the risks are there for sure, but I think the Fed is on top of the liquidity trap. The policies that are in place and the willingness to do more should really provide a backstop and prevent that kind of catastrophic failure. So I think we're actually in a, the Fed has our backs. Stick to higher quality. If you're confident in your stock picking prowess, you probably can pick off some pretty good value in some of the riskier areas, but I would wait. I think there's still some spread widening in some of the more difficult parts of the market to come.
Thank you so much, David. Very helpful. Leah, so just to build on your initial comments, can you, and this is a question that we also get from our clients a lot, about the risk management process for monitoring bond quality and, how reliable these investment, the rating agencies' credit ratings are?
Yeah, that's a great question. And certainly from the 2008 downturn, a lot of the rating agencies were certainly called into question. So risk management is really important. One of the things that really attracted me to Westwood when I came over to the firm is risk management is really part of our DNA. It's really in our culture. And we have a dynamic risk management group that all the investment teams, whether it's equity or fixed income, work with, and they actually have great analytics. And it's always good to be able to monitor different key criteria, but also any bias that you might have as a manager as well. But some of the key things that we look at is any significant price changes not necessarily due to downgrade, but it can also show where there's illiquidity developing in the market. So that's one item that we look at. We certainly look for missed filings of financials that can indicate that there's some risk or stress at a municipality. Whether or not somebody's lost a key employer, obviously that impacts your tax revenue base, and then also any macro themes that are going on. And again, we keep kind of revisiting energy, but energy is certainly one that's having some impact, but obviously will have a longer term impact on many munis. And I think you can never account for all risks, but it is a great way that we are able to really have a really strong process around monitoring what's happening with our purchases.
Thank you so much, Leah. And I'm a strong believer as well that risk management is really part of our DNA. So, David, next question is for you. Looking beyond 2020, what is your outlook for next year? And can you discuss where you see risks in other parts of the world?
Yeah, sure. So the question I ask myself really is, will 2021 be a different world with consumer and corporate behaviors changed? I think there definitely will be some of that, but maybe not so much as some of the pontifications out there would lead you to believe. I see it as there's three phases to really overcoming this virus challenge. One, you need widespread, accurate testing. Two, you need an effective antiviral treatment. And three, you need widespread immunization. So I think by the end of this year, the first two of those will be provided, and there will be an acceptable level of control that, with some continued behavioral change, should give added confidence to, I think, to the public. I think in 2021, we'll see a vaccine available, and that will allow for a re-engagement of most of our pre-COVID activities. So what we're going to likely see is a demand for products and services surge just due to pent-up demand as things come online. And this should translate into a much more robust recovery than we experienced coming out of, say, the financial crisis. So I think that should be very supportive for credit spreads, and corporate balance sheets will begin the process of repair. And we should get back into this virtuous cycle. Obviously, there's a long way to go before we get to that point, and I think navigating 2020 is still going to be full of trouble, snake pits. As for the global outlook, I think the downturn we're witnessing is, it's clearly everywhere and it's broad-based. You look at European and Europe and Japan, there's structural problems that haven't gone away, and you add the virus impacts, and it's just adding on top of that. Emerging market economies, with their US dollar debt, there's elevated risk of default there as local currency receipts dwindle. So, the coverage of those interest payments and the debt is questionable. Even in China, which is more advanced in opening back up, they're seeing lackluster recovery data at the moment. And that economy doesn't have the benefit of the stimulus measures that most of the developed economies have put in place. So it's a question. I think it's more prudent to stay at home stay at home currently. There'll be a time and place for global credit, but it's probably later this year as confidence builds and we can get a better idea of the shape of what the 2021 recovery will be.
Thank you so much, David. And just to follow up, how concerned are you about any sort of credit shock like what we saw in 2008, 2009?
Yeah. Well, personally, I view today's shock as quite different from the financial crisis. The current situation is, it's more broad, where that situation was definitely a product of the financial system, and this is obviously much more broad-based. But currently, we're seeing both monetary and fiscal authorities very aggressively tackling the program. And while, this could have evolved into that liquidity-driven type of collapse, the Fed acted again and again to prevent that. And I think Fed Chair Powell should be really commended on his actions and his leadership. Today's market risk is not one of liquidity anymore. It's really on, the solvency of individual companies, municipalities, and countries, et cetera. There's definitely going to be a shakeout in those areas that have no access to capital with high debt levels. But I think, as we've seen throughout financial history in this country, is that this type of weeding out of the weak is a sort of creative destruction, and really should allow our economy to come out of this in a much stronger position. So I'm actually, relatively positive on the recovery when we come out of this downturn. There's a lot of stimulus in place, and I think that this is quite different than what we saw in 2009. That was a systemic shock to the financial system. This is a very deep recession that we're in, with tons of stimulus, and I think that as we slowly open, I think that the bottom has already been set, and we should be able to kind of create value going forward from the economy.
Thank you so much. So these were all the questions I have. Thank you, Leah and David, once again for your insights. And I think I found this discussion very helpful. And just to summarize, I believe that the two key takeaways from our discussion are: number one, Westwood has a very robust credit monitoring process. And number two, as David and Leah mentioned, that while credit markets will likely remain fluid, we do not expect a shock similar to what happened in 2008 2009 recession. So with that, I'll bring an end to our call. Thank you everyone once again for joining us. Please reach out to your advisor if you have any questions. We hope you have a wonderful rest of the day. Goodbye.